Welcome to the Capital Spotlight, where we interview institutional investors to learn more about their strategies, sponsor and investment criteria, due diligence process, and asset management practices. I'm your host, Rob Beardsley, and today we have Lucy King with W Financial. Thanks for coming on the show.
Thanks for having me.
So to start, tell us a little bit more about W Financial, specifically about your debt fund as well as your JV equity platform.
Sure. So, W Financial has been around now for about 17 years, and that is a hedge fund which provides commercial bridge loans, and that operates nationwide, all 50 states, across all asset classes, and all loan sizes. And then the other fund that we have, Alternative Opportunities, which is what I'm primarily focused on, is a private equity fund, and that focuses on owning and operating properties in major metropolitan areas, and then also, investing in joint venture projects, acting as the LP.
So where does for the JV strategy, the alternative strategy, where does the capital come from? Is it dedicated, committed capital in the fund, or do you call capital?
Sure. So the way that it's structured, first of all, it's structured differently from W Financial. So W Financial is an open-ended hedge fund format. Alternative Opportunities is structured as a closed private equity fund. So the fund raised its $25 million goal about 2 years ago now. And then the fund has a life cycle, that extends till about 2023. And the capital is already there. So that's, a great advantage when, you're going to be purchasing the properties, because, we can arrive all cash in 30 days, and, it gives you an advantage when you're competing with other prospective buyers.
So have you used that all cash scenario to close quick and then refi afterwards?
Yes.
Very
Especially,
cool.
if there's an opportunity where, a seller has to move very rapidly, or with a distressed situation, we can be more aggressive on the pricing and everything else, because they know that we will be there since the capital is already there.
So you said the fund matures in 2023.
Mm-hmm.
What happens at that maturity? Are you forced to sell, or can you extend, or?
Yeah, so there's several extension options, that the principals can exercise. We don't really worry so much, I would say, about what has to happen by that X date, because again, you do have extension options, and the overall life cycle, the 5 to 7 years, is a pretty healthy amount of time, considering the value add business plan that we employ.
Mm-hmm. So you're typically looking for business plans that have a shorter time frame than the overall fund life, so call it something like 3 to 5 year holds.
Mm-hmm. Yep.
Got it. Okay. So I know you're focused on the equity side, but I wanted to touch on the bridge side, just talking about the current market environment. So what approach, how is your bridge portfolio performing, and what is the funds or the hedge funds approach to non-performing loans?
Sure. So, definitely right now, because, banks are more or less frozen. So you're seeing a lot more higher quality borrowers, higher quality deals, simply because, the bank isn't able to close with them at this time. So, you're seeing a lot of people that have to go and get a bridge loan, even though, they normally would be going straight into some sort of conventional financing option. So fortunately, we had low to limited exposure in hotel, retail, and we'd really been seeing a lot more loans outside of New York and, in all different other states. So, from that standpoint, the portfolio was in a great place, to weather the current situation. And then with non-performing loans, everyone is currently, looking for notes that they can purchase, searching for those deals. And, so far we're not yet seeing, the proverbial blood in the water yet. We think it's coming soon, but it's not, a tidal wave of disaster currently happening.
Right.
I think a lot of funds and a lot of investors are waiting, thinking it's time to get a great deal, but, the huge implosion has not happened as quickly as people thought.
Right. Definitely not as quickly as the way it looks in the public markets. What
Mhm.
about, so you guys are buyers of discounted notes and non-performing notes, or will you actually turn to look to acquisitions on the debt side?
So on the debt side, they're looking and they are actively looking for, note purchases if you can get them, at a discount, which again, not that many discounted notes currently for sale because, as I said before, the implosion hasn't fully happened yet.
What would you say? Obviously, it's very deal specific, but what type of buyer are you? Are you just looking for a small enough discount to get you to move, or is there some sort of return benchmark that the fund needs to hit in terms of getting a net, 10% discount, 20% discount on a performing note?
So it's really, it comes down to whether or not, they think that the deal, even if you can salvage it, if you can have a workout going on, that the deal still makes sense from really any standpoint. So it's not so much driven by, can we get a 20% discount, therefore it's a good deal. It's really driven by, no matter, do we think this is something that we could work out successfully? And is this something, that is at its core a good deal fundamentally?
So before we started recording, you talked about on the actually equity slash ownership side, there are deals where W owns them alone with, as the sole operator, and then also acting as an LP. How do you
Mhm.
guys look at a deal and decide if it's a better fit for one or the other?
So the two funds are completely separated. So on the alternative opportunities fund side, we're looking at it through a different lens. We're looking at it in that time horizon, and we're also, looking at a different total capitalization amount. So whereas, the W fund is much, much larger, and then on the alt-op fund side, it's much smaller. So in terms of the deal size, we're looking at two different really types of groups.
Got it. Can you talk a little bit more about those specific deal
Mhm.
sizes and deal type?
Yeah, so the areas that we do not delve into are hotel and significant retail component. Um, and that's, historically been the case. So we typically look for multifamily, mixed use, provided that, again, the retail component is not significant, or I'd say over 50% of the total buildings makeup. And, typically on those, we look for the deal size to be between $2 and $10 million. In terms of the debt, I know, a lot of different groups have different thoughts on how much leverage they're willing to tolerate. But in our case, it's the most that we can get. So we're fine going, 75% LTV, whatever, the case may be, just to increase the leverage as much as we can.
Very cool. So yeah, I want to talk a little bit more about that as well. In terms of max leverage,
Mhm.
what gives you the confidence to go after max leverage? Is it because that you're well capitalized elsewhere and can bring external capital to the deal if necessary, or what is it that gets you there?
So, typically, and again, it's a little bit different for the New York City specific deals versus in other markets. And part of that's, due to the nature that New York has rent stabilization laws, and it's, much more complicated operating environment. But so generally, to the outside of New York, we look at the existing in-place rent roll, and we make sure that it can meet the debt service if you do nothing. So if the property just continues to go with the status quo. And then, we also look at, certain geographic trends, very local economy where we think the rent realistically is going to grow to and how quickly it's going to grow. And then we look at how much work needs to go in to actually raise that rent. And on those, it's usually a little bit easier to find that pop in the rent rolls outside of New York City. Um, Another reason for that, which we've been seeing in the last property that we closed on in Chapel Hill, North Carolina is, the cost of construction. You can spend $2,500 and you have a decent renovation going on. Whereas in, New York City, that buys you half a kitchen sink. So we're definitely seeing that you can find more of a pop in the rent roll, which, gives you the confidence to achieve that max leverage, in outside of New York City markets or the New York City marketplace.
Definitely agree, right? There's examples, and a lot of the low-hanging fruit was picked up in this last cycle, but a lot of opportunities outside of New York and, in smaller markets throughout the country, there might be $600-700 rents that you could raise by $100 by just spending, like you said, $3,000 to $5,000, which is a lot of bang for your buck. Whereas compared to, even if you can raise rents in New York by $500, it may cost you $20,000 to do that. So the numbers
Right.
don't work out quite as well. How has the deals that you're looking for in the JV equity platform changed now that the onset of COVID?
So definitely, we're betting even more intensely, I would say, that the sponsors, because especially, in the current time, you really want to have sponsors where their asset management abilities are really, really, really great. So we're looking more, into if they have their third-party management in-house, and really, having them walk us through what their day-to-day asset management practices are, because we think that, that was always critically important, but especially now that's even more important. And then also how quickly, especially in this current situation, you need to be able to rapidly cut, your operating costs. You have to be able to, switch from budgeting. Maybe you were looking at 12 months. Now you need to be, looking at it every single day. So really looking for sponsors that are internally on their, in their day-to-day operations, just really, really well organized and really, really efficient.
Definitely makes sense. Let's talk a little bit more about asset management since you brought it up. And I know you guys, even as an LP, are pretty actively involved on the asset management side. So talk more about, like you said, you gave some examples earlier, but what you're looking for, and then also how you get involved on that asset management.
Mhm. So typically, what we'll do is we'll have, a series of phone calls, usually check in almost every day, with our sponsors. And, really what we found works very well is letting them, use us as really a sounding board. So if they can't, figure out what to do with, say a particular tenant or, with a certain capital project, we find that it's helpful if they just call and just go through, the pros and cons and, have another group of people to run some of their thoughts by. So, we found that to be very effective. And, another area that we help with is with vendors. So with negotiating with vendors, to get either, depending on the number of units that they have, to try to reduce the costs across the board for all the properties. That's also something that we're very involved with. And then also just monitoring all of, the expenses on the buildings and, constantly seeing if there's a way that, we can continue to try to lower them.
So based on your bridge book and some of the highlights on your website, it seems like you guys have a preference and a skill set for more complicated deals, quick closings, and strategies like that. Does that translate to the equity side? And do you have any examples of more complex deals that you execute on the equity side?
Yeah, so the lending side, in terms of a deal closing, they've gotten there in less than 24 hours. So in terms of the timing, and definitely, we can get one of them, to speak more to this on a future episode. But the second that they get a phone call, they can turn it around in under 24 hours. So on the equity side, in terms of that speed, it does not, we can't operate that quickly because the due diligence that you have to go through, and going through all the leases and then also really researching the market takes a little bit longer. So in terms of that time frame, and then the other, difficulty is once you put the deals together, or you put the property deal together, you then have to, negotiate with the JV partner and, just go through that whole process. So, I would say on the average, it's anywhere from 3 to 6 months on the equity side, from the time that, I get a call about the property to the time that we have the deed.
Yeah, that's definitely a much longer timeline than the bridge.
Mm-hmm.
You mentioned earlier that market conditions have shifted such that you're seeing a much higher quality borrowers come your way, higher quality deals come your way, and I'm sure you guys are taking advantage of that. What, in what way are you taking advantage of that? Are you increasing your pricing and able to capture some premium in the spread, or is it just that you're getting deals done at the similar pricing, but just with higher quality assets, higher quality borrowers?
So it's kind of a combination of those things. And the other constraint that's going on presently is, they always have to go and see the property. So that's typically, even in that 24-hour time, it's how quickly can you get on a plane? And especially right now, that's a little bit of a challenge because, no one's getting on an airplane. So, kind of shifting into, can we take a virtual tour? Can we do it remotely? Is another current thing that is slightly unique to this moment. So even, when you can take advantage of these deals, you still have to physically get yourself to the property somehow. So that's a little bit of a limitation at the moment.
Got it. Jumping back to the equity, you mentioned it could be a 3 to 6 month process. Can you walk through some of the main due diligence items and what you're looking for in terms of the deal, the market, the sponsor?
So I would say for New York City specific, which is the majority of our portfolio, it's a very different process than outside of New York City. So I guess for a New York City property, the first thing that we deal with is the rent roll. And with that, all the leases have to be reviewed. All of the tenants, we have to confirm that the tenant on the rent roll matches up with who's actually there. You also need to engage, a legal review of all the stabilized leases, of all the leases generally. And you have to go through that with counsel. You have to go and you have to check all the DHCR filings. You have to request all the DHCR filings. That alone takes anywhere from 2 to 4 weeks, depending on, how backed up that office is. Then you have to go through and, check on all the utility bills, check on, the property taxes. So I'd say that you have to do more in-depth look, especially when it comes to leases on the New York City specific properties. And then on the outside New York City properties, again, it's go through the leases, go through the rent roll. You don't have to typically engage a specialized counsel to review the leases, especially, on our most recent deal in North Carolina, where they don't have, any regulation when it comes to rent controls. So you can pretty safely assume that when you're reading a lease that it's accurate and that there's nothing that's going to become a problem down the line. And then with a lot of that, we rely on the sponsor to be the best judge of what capital improvements are needed and what deferred maintenance there is. So on that, we really lean heavily on the sponsor. And again, that's where we find it helpful, especially if the sponsor has in-house the property management, the construction management, and additional bonus if you have, your in-house construction company. So, because then you can also get the benefit of, they don't have to hire another third-party consultant. You don't have another layer of fees. It's all vertically integrated into one group. So I'd say that's definitely a huge, huge plus. Sponsors have that capability. So, we go through the deferred maintenance, the CapEx, look at the financing options, select one of them. And that process typically, I'd say, it goes quicker and more smoothly outside of New York City, just because you don't have to engage so many extra types of, the legal counsel, et cetera, to really go through the property.
So in terms of a property that's out of state, like the North Carolina property, how do
Mhm.
you actually get your hands on the leases to review them individually?
So, one great thing, and I don't know why New York City is still terrified of doing this, but in New York City, if you look at a deal, typically what you're working with is half a rent roll, if anyone even has that. No one, it's usually a lot of investigation going on. Whereas we found that in every other market, when you're looking at a property, the due diligence package that you're given, be it from the broker, if it's direct, it always includes, T12 numbers, and they're the real numbers, not, the made up ones. And you're given the leases, you're given everything in a nice little package. And it's not, I guess, is more of a like guarded secret as to what the property's real historical expenses are. And then once you have that information, it's much easier to project numbers forward because you have the real numbers going back, in one case, I actually got 15 years of numbers going back. And, and people don't, I don't know why this is, but they're more likely to just give all that to you up front when you're operating in markets outside New York City.
Very interesting. So obviously, W Financial originates bridge loans,
Mhm.
and then on the equity side, you're seeking max leverage. Does the alternative strategy entertain equity opportunities that include a bridge loan?
Um, so we haven't been in a situation where we've had to do that. If we were in a situation, where we would have to seek a bridge loan, and again, because the two funds are completely separated, one fund cannot benefit the other. So W Financial could never give a bridge loan to one of Altop's properties. They're completely, Chinese wall separated. So fortunately, we haven't been in a situation on the equity side where we've had to go and immediately seek a bridge loan. And I think one of the other great strengths, with the equity side is, the two principals have years and years and years of experience and relationships with banks. So when it does come time to negotiate for, loans on our properties, we tend to do very well because we have, all those relationships. And, we also don't typically have to go through, mortgage broker or anything else. We can just do it ourselves. So that's definitely something that's been very useful.
That's great. And what does the fund or your principals gravitate towards in terms of debt options? CMBS, agency, banks?
So it really depends on, what the plan is with the property. So usually we just try to go the bank route only because, agency, CMBS, they take so long to go through, the process and for the financing to arrive. So typically we just go through bank.
Got it. So earlier you mentioned that the Alternative Opportunities Fund is 25 million and it matures in 2023. What are your plans in terms of uh, growing that, raising a new fund? The timeline for raising new funds.
So, at the moment we're really focused, on our existing portfolio. I'm sure that, another fund would be eventually down the line, but at the moment it's not something that's, that we're really focused on. At the moment we're really focused on, running the existing properties. We're at different phases timeline wise across the board on the different properties, and, just trying to navigate the existing portfolio is really the main focus.
Got it. So this is an interesting question. What is something that you're looking for in terms of a deal type of strategy or the way a deal is structured that you're looking for from sponsors that you are rarely finding?
So I think that there has to be, and I'm hoping that possibly, with the current crisis, that people might start looking a little bit more closely at the relationship between the sponsor and the LP. Because what I've, often seen is that the proposed structure, and then also if you just look at it from the IRR standpoint, the sponsor, in a lot of cases, even if the deal doesn't do great, they're still going to make a lot of money on their fees and on everything else. So, I think that there's a huge misalignment of interests. Not always, again, there are tons of great sponsors, but I think that that's something that, going forward has to really be more considered closer. Because I think that, the mismatch of interests is just natural if you look at the fact that, typically they get a property management fee. So if the deal, isn't necessarily doing so well and I'm the sponsor, it's in my best interest to not say, let's sell the property. I want to keep my fee going. So I think, and I'm not sure what the answer to this is, because, the sponsors, this is typically that trade-off is how they keep the lights on. But I think that there has to be some sort of a shift in how, in how traditionally these deals are structured.
So you think you would value highly a structure that is better aligned in terms of skin in the game, shared income, and lower fees. So more performance-based compensation.
Yeah, so I think that there has to be more. I would say there has to also be, like the deals that, we've seen where you have like a 95% and 5% on the sponsor. I think that, that the amount of capital that the sponsor has in the deal, I think needs to go way up. I think like 70-30, 60-40 needs to start going in that direction. And, I think also with some of the fees, I think that, there either has to be a shared fee, so to speak, or just has to be kind of realigned. And I think the reason why, the fees and everything did get so kind of out there is because, good sponsors are hard to find. When you find them, typically they know that they're good sponsors. And so they know that if you're not going to come and be their LP, they're going to go find someone else who will and who will pay their fees. So I think, though, that that's going to start resetting, especially, as retail vacancies increase, everything else. I think that, that mismatch is going to start to get reworked.
Yeah, that's interesting. Definitely hard to find good sponsor, and then good sponsor plus good structure is twice as hard to find.
Right.
Okay, well, thank you so much for answering my questions and having a good discussion. Really appreciate the insights. Definitely allowed me to learn more about what you guys are looking for and, what you're doing in the market.
Yep. All right. Sounds good. Thanks for having me.
All right. Thanks.